Well, welcome back, everyone. Thanks so much for joining us for the last panel, which was going to be the second panel of the conference. And we owe quite a bit of gratitude here to Chip and his panelists for some cases having to rearrange schedules and calls, et cetera, to make this happen. So we really appreciate it. As we've mentioned before, this is going to be recorded. We're hoping that Mark Williams' portion was also recorded, or if not, will be, so that all of the panelists will have a chance to have their sessions recorded and available. And there will be an email coming out that will explain when and where you would be able to view those. Chip is going to announce the 2 CLE codes again, for those that might have missed the first one in the call yesterday. And what else? Please go ahead and post any Q&A. You can see down there at the bottom of the Zoom session Q&A, and we will hope to get to each question and answer for a particular panelist after that panelist presentation is over, since I know, for instance, David probably has to hop off after his presentation. He'll be going first, and so if you could just post some Q&A and we'll get to each panelist after their presentation is over. So with no further ado, with a little bit of deja vu, here is the market update panel. And we all know Chip as well as we knew him yesterday, so I won't bother going through his bio again, but please, I will turn it over to Chip now.
Thanks, Patty. Hi, everybody, again. Sorry to keep you after school, as it were. But we'll go straight to the panelists. You'll recall David Wagner is going to address LIBOR transition issues in which he's been heavily involved. He's with Houlihan Lokey, as you'll recall. And then Sasha Camper at American Equity is going to follow up with a regulatory update. She has been working on regulatory matters that affect the private placement industry for the PPIA, so she's well-versed in what's going on. And then I will finish up with a few document points. Patty's already covered CLE codes and questions at the end of the presentation, so with that, we can get started with David's presentation. David, take it away.
Terrific. All right, I'm David Wagner. Yes, I'm from Houlihan Lokey, but my background is really with a variety of banks and broker-dealers in the U.S., and I spent my time from 2014 to 2018 on the ARRC, which was the Fed's committee to establish an alternative reference rate. So it's the Alternative Reference Rate Committee. When we were established in 2014, it was an alternative rate, not a replacement rate. Somewhere around 2017, with some other events, it turns out that LIBOR is going to have a demise. And as some of you may have heard, LIBOR is ubiquitous, pervasive, and terminal. And the terminal part is what brings us all together today. LIBOR will be going away at the end of 2021. And there are things happening now in almost every asset class, every fixed income asset class, that are directly affected by the disappearance or the cessation of the world's most important number. So we're going to go through a few of those fundamentals and outcomes today, and then I encourage anybody that wants to look for more information. I'm happy to give out resources or whatever would help from there. But I thought we would start with a little bit of level set. So CJ, if you go ahead. Here's the first poll question. So if you've got your poll response out there, what's your client? And I'll view that as your public or your internal client, whichever one it is. Are you only now getting aware of LIBOR cessation? Do you know that there's somebody out there that's responsible for it? Is there a full-blown program in place? Or is there a robust program and visible progress and you know exactly what's happening? Go ahead and vote on that, and we'll take a look at the results in a second. I know that as I have asked this question over the last probably 18 months, as I've been doing a lot of consulting work on this topic, that things are getting better. I get fewer question or answer ones, only now just getting aware. And I start to get more people with exactly this response. We know there's somebody out there, or there may even be a program. It's usually about a third of people who say there's a program, I know it, I've seen it, and it's making progress. 12 months ago, that answer wasn't a third. It was probably something more like 10%, particularly when I talked to asset managers and insurance companies. Banks were a little bit further ahead of the curve. But this is reassuring. It's reassuring that that number is growing because the end date will not change. We can talk about that too. But CJ, go ahead, next slide. The first thing to talk about around LIBOR and its generally accepted replacement is how these two are different and why those differences create such a big problem, right? So I know a lot of people say, okay, replace LIBOR with something else. What's the big deal? One rate for another. Well, it turns out that the LIBOR is so embedded in so much plumbing and so much of the legal documentation in so many structures in so many ways that the replacement rate, if it's not exactly the same construct, really does create a bunch of problems. So let me go through these two columns for a second so you can see why these things potentially create issues. And I'll even back up for a second and say that SOFR is the rate that the Fed and then the ARCs, which is the Federal Reserve's public committee, has voted on as the replacement rate for LIBOR. However, there are other suitable rates in other private transactions that can be used and be completely appropriate. As you'll see as I go through SOFR, there are reasons why this one was chosen to be sort of the grand fundamental underlying rate, and a big part of that is IOSCO grants. But let me walk through these two. SOFR stands for Secured Overnight Funding Rate, where LIBOR, London Interbank Offered Rate. As a secured rate, SOFR is determined from the overnight rates on U.S. Treasury repurchase transactions, all reported through clearinghouses or the couple of big tri-party custodians. LIBOR is an unsecured rate. It has credit risk or counterparty risk. And it's a rate, in fact, set by experts at 11 a.m. in London for US dollars, which are in offshore banks. So LIBOR was never a fundamental construct, never had the domestic US market in mind. It was always an offshore construct. And it is unsecured, meaning you've got that credit risk. SOFR is administered, calculated, collected by the Federal Reserve. LIBOR is administered and owned by the Intercontinental Exchange, ICE, but regulated by UK's Financial Conduct Authority. So ICE, in fact, had a commercial profit motive for keeping LIBOR in place. They get paid to run LIBOR. SOFR is an overnight rate only. It's for 1 day. There are no multi-day tenors in SOFR. We can talk about the possibility of that later, but right now, SOFR is a single overnight rate. LIBOR, on the other hand, has multiple tenors, and we're all familiar with 1 month LIBOR or 3 month LIBOR, and those rates have embedded in it a tenor structure, which does not exist in SOFR. SOFR then is IOSCO compliant, meaning that it is, IOSCO came up with a few standards that were to be used for these benchmark calculations, and those standards are embedded in the benchmark regulation of various countries. But one of the biggest pieces of the standards is that it is derived from or observed really from actual bona fide market transactions and has long-term expectations of robustness. The U.S. Treasury repurchase agreement market meets those qualifications. There's about $1 trillion a day in overnight repo that's observable transactions. LIBOR, on the other hand, is often not IOSCO compliant. It does not have, particularly many of its extended tenors, sufficient transactions to meet the sort of market observability standard. And as $6 billion worth of fines have said, it is potentially subject to manipulation. SOFR has a futures market and cleared OIS swaps. OIS stands for overnight index swaps. And LIBOR has the same set of Eurodollar futures and a cleared swap market as well. CJ, next slide. So when I say visible, this is a Bloomberg screen. This screen's BTMM, and this screen shows all of the money market rates and repo rates and Eurodollar and SOFR rates So if you're not familiar with looking at the Bloomberg screen, and yes, I know I'm a markets practitioner, this is bread and butter, but let's look first at the upper leftish of middle where you see Fed overnight repo, and you'll see the number there for SOFR or SOFR of 7 basis points. If you look over to the right-hand side of the screen where LIBOR fixed are indicated, you'll see that there is a 3-month LIBOR fixing, and I think it's obscured on my screen, but it's 29 or 28 basis points. So you can see that the LIBOR fixings are, I'm just going to check it. The LIBOR fixings for 3-month LIBOR is, 25, I see it now, is substantially different than the overnight SOFR fixing. And you can then move to a little bit to the left of that, and you see that SOFR futures are visible in markets, and these are the futures for the 90-day periods associated with each of the quarterly contracts, and then 90-day Eurodollar LIBOR, which underlies the Eurodollar futures contract, is in the column to the right. So it's all available and observable in markets and arbitrageable between these two markets. Next one, CJ. I mentioned this this characteristic that LIBOR is, let's talk about 3-month LIBOR, is a 90-day rate known at the beginning of the period and payable at the end of the period. Well, SOFR is an overnight rate. So it's known at the beginning of the morning and payable the next day. It's only 1 day. In order to get a 90-day payment period, you have to observe the overnight rate 90 times and pay it at the end of the period. So if I go back through that slowly, and you can think about it from a borrower's perspective, the classic corporate borrower in LIBOR was told on the first day of the period what the interest rate was, and he had 90 days to know it and then pay it at the end of the interest rate period. Now, when he borrows under SOFR, he has to wait for 90 days of observations and then pay the next day after he's given the bill the night before. Those payment mechanics are one of the biggest issues around the corporate borrowing and corporate structure for banks using SOFR. So there have been some mechanics that are getting worked out in the FRN market, in the loan market, and the derivatives market to sort of adapt to this difference between a multi-day tenor and an overnight tenor for these rates. And one of the most common is, as I described, to simply average the rate over the period, or you could compound it over the period. You could add a payment delay in there, which means that you observe the 90 times, but wait a few days to pay. You could lock it out, meaning you could say, well, I'll only use 85 observations so that I've got 5 extra days to figure out my payment and make the payment. Or you could do a look back or lag where you shift that 90-day observation back 5 days so that you still get 90 observations, but from a slightly previous period. You can also do some other kind of observational shift. So all of these mechanics will be of relatively small value, but they are very complicated from a documentation perspective, particularly if you are adapting a document from a LIBOR mechanism to a SOFR mechanism. And those amendments or adaptations are one of the biggest sources of problems around this transition. Next screen. So the ARC put out this, and this is really what I just said before, but a little bit more diagrammatically, so you can see what I mean about the difference between an arrears payment or a lockout and versus the payment shifting. So you can go through this one. I won't go through it all again, but this one's a graphical representation. Next one, CJ. So let's talk about that thing that we saw before, with 7 basis points for SOFR and 25 basis points for 90-day LIBOR. Well, so you ask yourself, if you just change my rate to SOFR, who gets, what do we got? Who gets that difference of 17 basis points, 18 basis points? And the 18 being to the 25, someone gains or loses 18 basis points of yield. Well, ISDA, ARC, LSTA all recognize there is a requirement here for rough equivalence after we do this conversion. And that equivalence means that there has to be an adjustment between overnight SOFR and these multi-tenor LIBORs in every one of the tenors. So Bloomberg has been hired as the calculation agent. this reference, SUS003M, will bring up the spread adjustment. And this is the single number that gets added to SOFR in any contract where SOFR replaces LIBOR. LIBOR goes away at the end of next year, and you've changed that contract to make it make the fallback be SOFR. You will add this spread adjustment to it, such that on the day that SOFR is 7, you will have added 26 basis points, and then the equivalent payment at that point would be 33. If you were listening, you said to yourself, wait a second, you just told me before that LIBOR was 25, and now you've told me that with the adjustment, it's going to be 33. So my answer to you is yes, that is exactly right. The spread adjustment is a 5-year median look back, and it will be the single number that's applied to every SOFR payment calculation for the rest of the world's use of what was a LIBOR contract. So there will be value exchanges or current payment changes in the period in which LIBOR goes away. In other words, 90-day LIBOR, the day LIBOR goes away, will not necessarily equal SOFR plus the spread adjustment. So there will be payment changes or payment and valuation changes in the days, weeks, and months following LIBOR's cessation. Next, CJ. A lot of people ask, what's the difference in volatility between these two rates? How am I going to get hurt if I move to this overnight SOFR rate from the LIBOR rate that I was using? We've been through, in a number of ways, a very unique period in the last year, but this graph shows its particular uniqueness in as much as the green is the overnight SOFR rate. And you can see that about a year ago, just over a year ago, there was an enormous spike in the market. Actually, for not really any big reason, the repo market spiked, and that rate had a correspondingly big adjustment. It came back in line with the white line, which is 90-day LIBOR. And then when the pandemic hits in March, you can see that these two rates again diverged substantially. And as markets stabilized, May, June, July, those rates came back more into alignment. It's exactly this problem where you've got an overnight rate, which is more volatile versus the 90-day rate, that the ARC and LSTA and ISDA have all started to use these long period median adjustments and using averaging over periods to replace 90-day LIBOR to eliminate some of this volatility. Next one, CJ. And then if I further look at this, if I look at the same data period, I can see from a histogram perspective that the current average spread is 15, where the spread adjustment, which is a 5-year median, is 26. So there will definitely be differences. You can also see in that histogram that there are tails of outcomes. And so this fundamental mathematical problem is one of the big issues to a practitioner whose payments are focused on near periods of LIBOR versus SOFR when cessation happens. CJ, next one. So now that we've talked a little bit more about the differences between LIBOR and SOFR, what are you thinking about? Do your clients, do they have some differences in mind, and do you think it's informed their strategy? So do they have a strategy yet? Is it mostly one where they're saying, well, I just want to make sure I don't get hurt, a defensive one? Is it an offensive one where they're saying, well, if I get ahead of this and figure out what a competitive advantage could be or how I could profit from it? Or is it better just to go home and ask tomorrow? While we're on the screen and you're voting, I will tell you that there is a minority in the market, and I'll talk about this in a second as I zip through the rest of these slides, which believes that they have the ability to buy a piece of paper which may convert, let's say from LIBOR time, they'll earn 275 basis points extra on that conversion, and they will be willing to litigate to protect that increased rate. And I would call that an offensive strategy. So there are offensive strategies in the market and defensive strategies. And these results, again, sound fairly consistent that most people are thinking about it defensively or cost sensitively. I will say that there are some some real thought points here about the benefits of an offensive or a competitive advantage strategy. Next one, CJ. Okay, so big question, right? What actually happens when LIBOR stops? Go ahead, CJ. So bam, BTMM, same screen. LIBOR doesn't show up, it's blank. And what else is blank? Eurodollar futures. So anything that had a reference of LIBOR will be incapable of having a price. There will be no LIBOR. And this is the scenario that the world is facing on January 1st or January 2nd of 2022. When we wake up in the morning, we go to figure out what the payment is on a deal, and there is no LIBOR. Next screen. In that case, on that day, and hopefully well before that day, but on that day, you'll get called up as an attorney and somebody's going to be screaming on the phone saying, what are we supposed to do? And what we're supposed to do if LIBOR doesn't show up, the industry is generally referring to as a fallback provision. What rate do we fall back to if we can't find LIBOR? What's very interesting is that LIBOR fallbacks were typically written around temporary unavailability of LIBOR. Most documents do not contemplate the permanent cessation of LIBOR. So this documentation can be silent or confusing on this enormous market structure change that we're going through. Loan agreements are amendable, right? And we can work on those before cessation. And securities, though, are not amendable for the most part. There are other processes you could try to use, but there's a lot of securities out there which are not amendable. So they create their own unique issues. But the language, particularly in securities, that is designed for temporary unavailability is definitely going to create a value transfer when it comes down to the permanent cessation of LIBOR. And if I just go through an example, I talked about the prime one before. Let's also talk about one which is very typical for securities, where it essentially says, if you can't find LIBOR and you've tried a few places, just use the last LIBOR. Well, that's great if a new LIBOR is going to show up tomorrow. But if no new LIBORs are ever going to show up, then you've turned that floating rate security into a fixed rate security at the last LIBOR. And that could be a substantial value impact. And this is something that we're calling the legacy asset issue. CJ, next. I'm not going to read this. This is the typical language that shows up in securities and talks about all the places that you're supposed to go and look. What I find really interesting is that most of this in the market structure change that we're talking about will be entirely unexecutable or irrelevant. Next one. This is the language that the LSTA is proposing, and there has been similar language already put into a lot of, I think about 800 FRNs that are out there. And it says that there's a defined fallback, and this new defined fallback looks like these examples. It says go to a term SOFR. Term SOFR doesn't exist today. So then it says go to use daily simple SOFR. And in both cases, you have to do that spread adjustment that I talked about. And the third rate, if there's no SOFR, is a borrower administrative agent rate. But the Fed is highly confident that daily simple SOFR will be available. They've committed to publish it. So that will be the defined fallback rate in all new loans. Next one, CJ. There's a couple of things that will drive this to happen. There are cessation events or triggers. There are pre-cessation, where a regulatory body could declare that that LIBOR is no longer representative of what it was intended to be, and therefore it doesn't qualify any longer as a benchmark rate. And that will trigger a few things if that trigger is in your documents. And that trigger will be in many documents by December of next year. The other option in this new language is to have both of these triggers and to have another opt-in where both parties could essentially say, let's get out of LIBOR and just shift to SOFR sooner than its cessation. And those are the kinds of things that the market is hoping happens in order to avoid the sort of pig through the snake problem where everybody rushes to make their changes on the same day at the same time. Next one, CJ. So legacy assets we've talked about a little bit, and there will definitely be unintended value transfers that happen in the securities world. And for those of you who are attorneys or work as counsel for insurance companies. I know that I've already participated in a number of document reviews around securities that insurance company holds in their portfolios, where they want to know what's going to happen to these securities that I hold in the event that LIBOR goes away. And we've seen the potential for significant value changes. They want to know about the various proposals, the regulate, legislate, but we believe that the most likely outcome in the US for a lot of these legacy assets will be litigate if they haven't been taken care of in one way or the other ahead of time. And it's hard to actually come up with real solutions for some of these assets that need 100% consent. CJ, next one. So that was my 23-minute speed walk through LIBOR world. There's actually a ton more in this proposal, in this presentation, but I don't think it's appropriate to go through it today. Let's just do this last poll question. So if your client was going to have a contract review, does that mean that you've got a lot of people reading documents all night? Do you have a robotic solution here? Is there a hybrid here that you see as more appropriate, where you do machines and some kind of human quality control, or do you simply throw up your hands and outsource it to the next guy down the line who's got either inexpensive labor or some other solution? What we are seeing in the banking world, where they've got 13,000 loan agreements that need to be amended, is that this needs mechanical solutioning. It's interesting that from the perspective of a group of counsels, you see a lot of reading. When I talk to a number of clients, they see a lot of call the robots. They do believe that there's an AI solution here, partly because, particularly for securities which are not amendable, it's not as critical that you have 100% accuracy, and where you would look for that if you were in a hybrid machine and human quality control solution. But those are my observations on LIBOR. There is a ton going on in this market. The hardwired fallback for loans was an ARC best practice recommendation 2 weeks ago, so that's in place and active. The exchanges have just changed all of the discounting to a SOFR curve that affects $1 trillion of collateral, and ISDA just announced their supplement and protocol for all derivatives contracts. That's out there now, and it'll be effective January 25th of next year. And there is a potential that the UK's FCA will call for a pre-cessation trigger in January of next year. So this is a very active space. I'm happy to answer any specific questions. Let's see. I see one in the chat here.
Yes.
Yep.
You see
in
that?
terms of SOFR, why not simply use the prior 90-day average for the subsequent 90-day period, so they both have a single preset rate? Absolutely. So that is a perfectly logical, absolutely applicable, and economically viable solution. Not everybody likes it. A lot of people don't like the idea that you've got this previous period for the next period. Some people have said that's a great solution for 30 days, like for monthly deals, but not so much for quarterly deals. So there's a lot of varied opinion. There are some studies that show that some of these things do have bias, but your observation here that fluctuations would be picked up in subsequent period is almost totally true. There has been a persistent upward bias in 90-day tenors versus overnight tenors. So there still is, if you look at it historically, the historical analysis still says that there is a little bit of a difference, but it's in single-digit basis points, 1, 2, or 3. I see another question about the legislative solution would solve the legacy issue, question mark. Really big, I'll call that a really big question mark. And I would defer absolutely to the counsels who were involved in the specifics, but there are a couple of issues that I'll point out with this. First is that the legislative solution is predicated on the fact that it's only for things which do not have fallback language. If you have fallback language, even if it's bad fallback language or says, go to prime, the legislation wouldn't solve that problem. It's only directed at things which have no fallback language. And then so only for New York law, not for Delaware law. And it's also potentially got a constitutional challenge involved. So it's clearly a good first step and a way forward for some things, but there's still a lot of discussion about its applicability.
Any other questions? Okay. If not, David, thanks very much. David, I think, is going to have to get off of the video because he's got a call in about a minute, I think.
Yes.
But before we
very
go,
good. Thank you all.
Thanks, David. But before we go to Sasha, let me read the first CLE code, which is 46872. To repeat, 46872. All right, Sasha, talk to us about regulatory developments.
Sure, thanks, Chip. I guess I just start out by saying I work at American Equity, and I am a member of the regulatory committee of the Private Placement Investors Association, where I co-chair that committee with Brian Keating of Guardian. As such, we spend a lot of time working with the NAIC on regulatory changes and issues that can impact investment decisions for insurers. And Charles Theriot, the head of the SVO, was originally supposed to present this presentation with me. So while there's no SVO logo on these slides, they did contribute a fair amount of the content. So shout out to Charles there. We want to get started, CJ? When insurers purchase securities, there's basically two ways that the NAIC can assign risk to that security. The first way is for the insurers to file that security with the SVO for a designation. The Securities Valuation Office would look at financials, the MPA, private placement memorandum, perhaps the insurer's credit write-up and assessment of the security, and assign a designation. The other option is that the security can be rated by a nationally recognized rating organization, or what the NAIC terms as a credit rating provider, so a rating agency. And typically, if a security has had a rating from a rating agency, then you didn't need to file it with the SVO for a designation. You could just defer to that rating agency rating for capital purposes. Next slide, CJ. Historically, the NAIC just relied straight on those ratings. There was no interference from the SVO's perspective, and it was a very formulaic method. If you have one rating, they defer to that rating agency's rating. If there are two ratings, they'd take the lowest, and if there's three or more, they'd take the second lowest rating. Then you see this translation chart at the end of the slides, which basically translates the category of rating assigned by the rating agency over to what the NAIC equivalent designation would be, had the NAIC rated it, and then we'd apply risk-based capital accordingly. Next slide. Traditionally, there's been 6 categories for the NAIC. That is changing, and they are becoming more granular. So this year, they moved from 6 categories to 20 categories, which align much more closely with the notching that we see from the public rating agencies. And this change does not impact risk-based capital yet, but we fully expect that this is a transitional step, and probably sometime in 2022, if I had to guess, we will see the new, more granular designations from the SVO translate over to capital requirements. Next slide. So there's pros and cons to getting an outside rating, being filing exempt, as we call it. From the SVO's perspective, the only benefit they see to filing exempt is that it does take some resources off the SVO staff. There are just too many securities out there between the public and private space for them to be able to rate all of them. And you know, Charles isn't here, so I can speak candidly. I think industry's opinion is that there are certain categories of securities that perhaps maybe the agencies have more expertise in than others. That's not true across the board. There are some very bright analysts at the NAIC, but some of the more specialized categories, they don't really have as deep a bench in. But the biggest benefit to me as an insurer when I buy a security that has a rating is that it takes the guesswork out of trying to figure out what you think the SBO might rate it. You already have a rating, you know what that translates to in terms of capital, and so I can price that security accordingly based on my own internal ratings as well as, you know, what the capital required rating would be. The cons, and these are really things that the NAIC is concerned about justifiably. Not every rating agency is consistent in its methodologies, certainly not across rating agencies, and even sometimes within the rating agencies across asset classes or sectors, there can be material differences, and their methodologies might not be consistent with the way an insurance regulator might view it or choose to rate securities. In addition, we have seen certain types of securities that the NAIC would argue are ineligible for filing exempt go out and get a rating, get a private ratings letter, and insurers have been using those private ratings letters and not filing those securities with the SVO. The NAIC views that as a form of capital arbitrage, and rules are going to be changing going forward as a result of that. Next slide. So risk-based capital, Chip and other counsel that I work with have asked me multiple times, how do I calculate risk-based capital? How do I know how much it costs to move from a triple B asset to a double B asset? And I think anytime that you've asked your clients that, you probably have gotten really fuzzy answers. And part of the reason for that is that risk-based capital varies insurer to insurer. It's an insurer-specific calculation. It is usually closely protected. It's something calculated by the actuaries or sometimes the accounting staff. It's not usually shared with the front office. And so as a front office person on the investment side, I'm probably not able to speak definitively how risk-based capital is calculated. But these next few slides, I'm going to try and walk you through and just give you a sense. So the NAIC designations right now, on the right-hand side here, you can see that there is an assigned C1 RBC factor. C1 just means basically the main measure of risk for asset risk. So if I have an NAIC 1 designation, I'm using that 0.4% factor. And you can see here that these factors grow exponentially over time. So, with credit quality deterioration. So this is why, from an insurer's perspective, it's really, really important, if we can, to have as many securities rated NAIC 1 or 2, because beyond that, the factors start to get quite steep. Next slide. We talked a little bit about this, so I'll go over it more in a minute, but RBC is unique to each insurer, and it's kind of considered to be proprietary information, which is another reason that you probably don't get a straight answer from us as investment folks. But the general rule of thumb in the market is when someone falls from an NAIC 2 to an NAIC 3, if we're negotiating an amendment, you usually try and see investors ask for 100 basis point coupon bump, plus or minus. And the next slide will give you a little insight as to why that is the case. Next slide. So please do not take this slide home to your actuaries and ask, because they will tear this apart. But Chip really wanted me to give you a sense how to get at this number. And this is a really crude way to try and figure out, well, what is your RBC cost associated with an asset? Now, there are some other factors in here that probably get thrown in, and it's going to be different for every insurer, but these are kind of the three main categories that will drive most of the cost. So you start with your cost of capital as an insurer, and then you multiply that by the C1 risk factor that we showed on the prior slide that the NAIC requires for a security with that rating. And then lastly, it's important to understand that risk-based capital is not the threshold that most insurers hold for capital. It's the required minimum that the NAIC would require you to hold. But I have seen insurers with, 125% or 150% of risk-based capital, and they still are insolvent at that level. So it's a very low standard, and most insurers, especially if you want an investment grade rating from the rating agencies, you're going to target somewhere between 350 and 450% of required RBC. So I just shot down the middle with a crude example here. Let's start with an insurer with an 8% cost of capital, and they're targeting 4 times or 400% of RBC. Then the way you'd calculate for that insurer, the RBC cost, is taking the 8% times 4 times the C1 risk factor. And you can see here I've calced out what, for this example, what would be the required cost for a triple B coming in 42 basis points. A double B comes out at 154 basis points. And lo and behold, the difference between those two is not far from that magic 100 basis points that the market typically shoots for in an amendment. Next slide. So just a quick question for you guys. When you work with your clients, how important is RBC in their decision-making processes for investments? Very important, somewhat, marginally important, or not important at all? Do we have a very important? I'm not surprised. Most of us focus on this very heavily, especially if you're a public company. The mutual companies may not focus quite so heavily because they don't have to worry about reporting to shareholders. But even for rating agency purposes, this is a factor that's looked at pretty closely. And so most of us really need to take into account what we think RBC costs will be, and we're trying very hard to optimize it. And that's why all of this matters, and all these changes coming from the NAIC matter so much. Next slide. So the NAIC is in the process of trying to get more control over filing exempt securities. And we've talked a little bit about some of the things that the NAIC is concerned about, the lack of a standard methodology, the fact that the rating agencies might view things differently than they do. One point that is important and is something that maybe industry can work to fix going forward, there are plenty of private ratings letters out there that don't have the NRSRO's rationale posted in the letter. All it has is, we're Egan-Jones or we're Fitch and we rate this BBB minus. And that's pretty much all the letter says. That's really concerning to the NAIC because they want to have some sense of quality control. And when they see that, they have no idea how in-depth the analysis was and whether they agree with it or not. So that's a simple change that industry can start working on with the rating agencies to try and help the NAIC get comfort. But I think there is a growing sense within the NAIC that, even with the largest, most established rating agencies, there was a precedent just 15 years ago in the market where blind reliance on ratings ended up with problems of a systemic nature. And I think they are seeing some things on the rating side, particularly on the private letter rating side, that bother them, and they want to try and avoid that type of problem again. Next slide. So going forward, what's coming down the pike? This spring, the NAIC released an exposure called the Bespoke Securities Exposure, wherein they listed several types of securities that they consider kind of worrisome, especially if they're between affiliated parties or not marketed broadly to the market. They're between 1 or 2 investors and have private ratings letters. They want to try and understand that space and at times potentially have the ability to override ratings in that space. The exposure draft that went through, however, the language around it was somewhat ambiguous and potentially broad. And if passed and accepted as proposed, would essentially give the Securities Valuation Office the right to override any rating. Industry has responded back with a proposal saying, hey, we'll file all these private ratings letters for you to give you visibility and transparency. You can follow up and ask for detailed deal documentation on any securities that you want to study further. But what we'd really like you to do is, rather than overturn ratings deal by deal and have complete discretion for the SVO to do that, we'd really rather that the SVO focus on kind of the big concerns that they see, certain categories of securities in the market that they find particularly aggressive from a risk standpoint, or that they materially disagree with the ratings, not just, oh, we'd rate this 1 or 2 notches lower, but things that they see have the potential for systemic risk. And to do that with their bosses, the regulators, the VOS task force, to bring out those concerns publicly. So industry has a chance to have a dialogue about that and potentially be part of the solution. If we get to a situation where the NAIC is, or the SVO, is overturning ratings on a deal-by-deal basis, and there's no kind of public airing and transparency of that process, it's going to cause a lot of uncertainty in the market, and it will have serious capital implications for us as insurers. That proposal has gotten some initial feedback that there seems to be reluctance within the NAIC to adopt our approach. We're still in discussions with them, and we're hoping we can come to some sort of agreement soon. Next slide. One of the big concerns at the NAIC are structured securities. You know, the market's evolved. We see a lot more entrepreneurial types of transactions or new deal structures than what we've seen in the past. And the concern from the NAIC about some of these structures is, especially in the situation where you're using an SPV and you're contributing assets that may not be truly fixed income assets into the SPV and issuing debt off of them. The concern is that industry is trying to arbitrage and get debt treatment from an RBC perspective for investments that would otherwise be equity if they were held directly and not vis-a-vis an SPV. And so some of these next slides address some of the deals that they find most concerning. Next slide, CJ. These are 3 different classes of securities that the NAIC is really concerned about. The first is principal protected note. And the next 2 slides actually show you mathematically some examples of principal protected notes. In the interest of time, I won't go through those slides directly, but I'll try and describe for you now how a PPN works. So you have an SPV, and you contribute to the SPV a mix of fixed income securities and some sort of risk security, whether that risk security is equities, equity investments, or an S&P 500 option or derivative investment, or maybe even something like commodities. But think of kind of high risk, highly price volatile assets combined with some form of fixed income security. Oftentimes the fixed income security are 0 coupon treasury strips that accrete over time. And the deal is structured, then debt is issued from that SPV, and it's structured such that it has a guaranteed interest payment, but a really thin level of guaranteed interest payment, maybe 1-2%. And there's enough fixed income or treasury component inside that structure such that it can service that 1-2% and fully pay off the principal at maturity. In these structures, they bring them to the rating agencies, and the rating agencies will say, well, you know, your guaranteed interest of 2% and principal, and it's fully backed by treasuries. This is a AAA security. But from the NAIC's perspective, they're saying there is no way that someone would buy this debt that's were it not through this SPV structure. They're really buying equity and they're buying treasuries. Okay, we get that the treasury part should be rated AAA, but the equity component, that should get 30% RBC treatment, really punitive RBC. And that investor is really expecting, you know, maybe a 7-8% return. And the rating agencies aren't rating to the probability that they actually earn that 7 to 8% return. They're only rating to that really thin interest payment. NAIC views that as risk arbitrage. They've already come out with a statement saying these are no longer filing exempt securities. They have to be filed with the SVO, and guess what? The SVO rates them high yield. Combo notes were on that same exposure along with principal protected notes. A combo note is when you take 2 or more slices of CLO debt and you throw them into an SPV, and then you issue debt out of that SPV, but the debt that gets rated out of that SPV tends to be heavily weighted towards the higher rated tranches in the CLO, or excuse me, within the SPV. If you actually did a dollar weighted risk rating for each of the 2 or 3 tranches that sit in the SPV, you would probably come up with a much lower rating on average. But the rating agencies, for whatever reason, have been willing to give deference to those highest rated securities. What really irritates the SVO is when people do combo notes and they have some sort of debt component of the CLO and then the equity residual component of the CLO sitting in the SPV structure. And then they go and get it rated and get debt treatment and hold that on Schedule D. Again, they view that as capital arbitrage. Effective just this past year, CLO combo notes are no longer filing exempt. The SVO will rate them. The last one, collateralized fund obligations, this one's still under debate. A CFO is when, for example, private equity players, they have their co-investment in each of their funds that they manage. And that co-investment is then, slices of that co-investment are then collateralized together, thrown in an SPV, and securitized. In those securitization structures, there are usually over-collateralization. There is usually, a debt service vehicle or various other ways to protect downside risk for debt investors that purchase debt from that SPV. But the NAIC looks at it and they want to take a broad stance to say, we're giving look-through treatment to anything issued out of an SPV. And so to them, they see debt being issued out of that SPV, but all the underlying investment is equity. And they're saying, no, that's an equity investment. That should be given equity RBC capital. CJ, can you advance 2 or 3 slides here? Go ahead. Thanks. So CFOs are still under debate. Industry is trying to argue that some CFOs, if structured appropriately, should be given debt treatment, and the jury is still out there. We have been trying to argue with the NAIC that we understand that there have been some abuses in industry and we want to work with them on that. But we view some of these changes as kind of changing the rules midstream. And as such, we would like to see grandfathering. And we really take issue with this whole look-through concept, looking through the SPV to the underlying assets. Not only does that have implications for CFOs, but it has other implications for things like credit tenant lease deals, equipment trust, particularly those that are not contractually tied cash flows fully to the lessee. So for example, if you have a balloon payment at the end of that structure, such that there's refinancing risk for 20, 30% of your debt, and that rail car is no longer on lease and has to be released, the NAIC would argue, well, that's not a bond. And investors are trying to say, well, yes, it is. And we're working through these issues. Next page, CJ. The NAIC's view is, well, yeah, we agree. Most of you are trying to play by the rules and trying to help us eliminate abuses, but there are some players that are bad actors out there. And grandfathering only encourages more bad behavior and rewards the bad actors. So on PPNs and combo notes, for example, there was no grandfathering granted. And on CFOs, we'll see where this goes. Their argument on CFOs is if you have an asset inside the SPV that's not a fixed income, natural cash flowing asset by its nature, the only way we will give that asset bond treatment is if there's some sort of obligation, such as a lease or some other contract, by which there will be cash flow to service your debt throughout the entire life of the debt. If you can show that, then that is debt. But if there's some element of payment of your debt that is contingent on the underlying asset, and that underlying asset is not debt, they want to categorize it as something else. Next slide. So quick questions. Your clients, how often do they invest in PPNs or combo notes? Do they? Do they not? Do you know? Do we have results, CJ? Okay. I am not surprised to see this. These structures are not necessarily heavily invested in by all insurers. And that is in part why industry didn't completely raise holy heck on this specific issue. Next question. How often do your clients invest in CFOs? Yes, no, don't know, or you don't really invest, but you're interested in this space and would like to learn more. Many of you don't know. A few of you have been investing, and a good chunk say, no, we haven't invested yet. And CFOs, again, I think are more specialized asset classes. Not everyone invests in them, but I think all of industry is really interested in this particular issue and how it gets resolved, not necessarily because of the impact it has directly on CFOs, but because of the broader implications for things like project finance that isn't fully contracted out and has some element of generation risk, equipment leaseback securities where you might be taking refinancing risks, credit tenant leases. Those are more broadly invested in by most insurers, and what happens with CFOs has implications for those assets.
Chip, sorry to interrupt, Sasha. Chip, can you go ahead and read the second code in case some folks have to drop off at 5?
Oh, sure. I was going to do that at the end of Sasha's presentation, but the second code is 90756. 90756.
Thanks.
Thanks, Patty. I was just going to suggest that. Next slide, CJ. Chip had asked me to talk about a proposal that was on the table regarding a sovereign ratings cap. In the interest of time, I'm going to skip most of these slides and move on to an issue that's more directly at hand right now. But suffice it to say, the NAIC did propose a while ago that any issue from a sovereign domicile that was rated higher than that domicile by the NRSRO would be capped at the sovereign rating ceiling. Industry fought back on that issue hard. There's a number of deals that we think deserve to be able to pierce the sovereign ceiling, especially if you have a global borrower with assets all throughout the globe and revenues all throughout the globe. The NAIC decided to temporarily shelve that proposal. It has not gone away. It could resurface, so it probably behooves you to look at these slides later and talk with your front office about them. But just know that for now, this is not an immediate issue. What is an immediate issue I'd like to talk about are material change event filings. And traditionally, the NAIC had required industry to file securities mid-year if there were any material change in the underlying asset. And industry had historically assumed that that meant change in payment terms. So if there was an amendment and you chose to pick interest or you chose to extend maturity, then you'd need to file that mid-year as a material change. The SBO is taking a more aggressive stance at this point. They're saying, no, we want anything that's had a material change in credit quality to be filed. And their language in the PMP manual is actually fairly broad, and it could potentially result in a huge amount of work across the industry, depending on how broadly or narrowly you wanted to interpret that response. What PPIA has done to try and get their arms around this is, and the other thing I'd mention is the SBO has threatened if industry doesn't comply and start filing these mid-year filings, they could unilaterally step in and start lowering designations on securities if they feel that there's justification that those securities might be at risk. Next slide, CJ. So to try and get our arms around this, PPIA and the NASVA Association, which is the group that handles a lot of the filings from the back office perspective, we've gotten together and tried to draft some crude guidelines about what merits a material change. What are the criteria that we should be looking at to say, yeah, this is enough, this merits a mid-year filing. Just as with regular new issue filings and annual update filings, we're looking to the lead investors for each tranche of an MPA to do these filings. But where we need the help of ACIC is when you have amendment calls going forward, especially if there are multiple MPAs, so maybe there's the 2019 MPA and the 2015 MPA, and we're all in the same amendment call, we need you to be raising the issue with the insurers. Does this rise to the level of a material change? And if so, who wants to be responsible for the filing? Because what we don't want to have happen is someone who holds the 2015 amendment says, yes, that's a material change, and then files the paperwork. And the NAIC has in its system that that same issuer has the 2019 amendment and no one filed anything there. In that situation, they're going to look to industry and say, you're not doing your job, you're not filing these, we're going to start taking matters into our own hands. We feel in a lot of these situations, the more information we can provide on a proactive basis to the NAIC, the better, the more likely they might give us the benefit of the doubt and not be so onerous on ratings. For now, we're going to focus on the industries most heavily impacted by COVID, so aviation, retail, energy, the sports and stadium deals, travel, lodging, gaming, the things you'd expect that are going to be completely shut down right now. That's where we will focus. But this is not just a COVID-related change. This is a change in kind of policy from the NAIC's perspective. And so going forward on any deal where there's a substantive amendment, we should be asking that question and doing those filings where appropriate. So anything you guys can do to help on that front will be appreciated. That's all I had. Are there any questions at this point?
I do see.
Looks like there might be a couple.
Yeah, we do have one question.
Okay. What prompted the NAIC to take these assertive stances? Have insurers faced liquidity or solvency issues of late? Yeah, the short answer is there was one insurer. It wasn't, I don't think, a particularly large insurer, but it had a particularly bad insolvency outcome. And that insurer especially was doing a lot of affiliated transactions where they were selling securities to an affiliate at highly discounted prices. Some of you may remember there used to be a called the modified FE, a modified filing exempt matrix. So if you bought a deal at a discount, you could actually hold less capital against it than if you bought a deal at a par or at a premium. So one affiliate selling bad deals, bad assets to another affiliate at a discount, they're getting a private ratings letter, and then they're able to hold much lower capital as if it were rated much higher because of that mod FE concept. Mod FE has gone away, but they were doing that trade in mass as well as some other kind of sketchy types of activities, and they went insolvent. And that was kind of the big wake-up call from the NAIC's perspective that, hey, there might be more going on in the hood with private ratings letters than we have previously thought. They also have seen some things and heard some things, I think, through the grapevine. And they claim, we don't know, but they claim there are certain insurers that are doing things they're very uncomfortable with in mass. And I think they're very concerned about solvency issues, and what they don't want to have happen is a large systemic crisis that evolves and then the NAIC looks like it was asleep at the wheel. So that has started the concern, and that's why all these changes have come through. And I think, and that's understandable, you know, from a regulator's perspective, I would have discomfort not knowing there's this book of securities here that I don't know anything about. I have ratings on them from an organization, but I don't have their ratings rationale. I don't know how they got there. I don't know if I agree or not. So industry is, you know, sympathetic to that. And I think some oversight is probably a good thing. And what we need to do is work proactively with the SVO and the NAIC to avoid unintended consequences, make sure their actions are well thought through and, you know, workable from an industry perspective, that it's not an overreach, that it really is the right amount of transparency and regulatory oversight. Chip, I think I used all your time.
Thanks, Sasha. For those of you who just want to be done, if you can hang out for 10 minutes, I can get through what I have to say. So let me start with the next slide, please, CJ. Okay, I started this yesterday. Some of you have already heard it, I'm sure, but the deals are now getting done with a make-whole holiday, which means that if the notes are prepaid in the last 3 or 6 months, usually, of the term of the deal, there's no make-whole payable. Whether it's 3 months or 6 months seems to depend on the term of the notes. Longer term, get the longer 6 months. Shorter term, get the 3 months. The justification I've heard is that it's administrative, really. It's a pain in the neck to match up new fixed rate financing with maturing fixed rate financing, and why go to all this trouble to make whole so small? Let's just let it go. So I wish Mark Williams were still on so he could tell me his thoughts on that, but he's not. We had one deal recently where the make whole holiday morphed. So CJ, can I have the next slide? If you look under the definition of reinvestment yield at the bold-faced language towards the end, you will see that there is an assumption there about the maturity date of the notes. And what this means, or what was proposed in this deal, was that if there were a prepayment of the notes at any time, first year, second year, not the last 3 or 6 months, that the make-whole would be calculated as if the maturity date of the notes were 6 months earlier than it actually is. Now that did not get accepted. The investors rejected that proposal, but it may be a harbinger of things to come. So first polling question, I'm curious whether you have seen this type of provision, not the basic make-whole holiday, but this difference where if you prepay at any time, you pretend the notes mature earlier than they actually do. Any results, CJ? Has everybody left the conference? Oh, so some of you have, okay. Fair enough, but nobody's agreed to it. Okay, well, personally, I think that's good. Okay, let's move on to the next slide. Series by series prepayment, as you all know, the model form requires that optional prepayments in part be made ratably across all series of notes, not just to one series. But of late, there has been a move for permission to prepay one series of notes without the ratable allocation to all the notes. There is frequently, in almost all cases I've seen at least, a limitation on that permission, which is that there not be a default or an event of default existing at the time of the prepayment. And if there is, then any prepayment made has to be made ratably across all of the notes. Next slide, CJ, please. We've had that in a number of deals, and the one issue that is in the back of my mind, it hasn't actually arisen in practice, but is what happens if an issuer with a series by series prepayment right goes to one series, which let's assume has a majority of the notes, and says, look, I'm going to optionally prepay you, but I want you to agree to an amendment, covenant loosing, obviously, in order for me to exercise that right. It's not clear to me that the model form blocks that type of action, because it doesn't seem to me that there is remuneration being paid to the holders of the one series. because that is defined, as you can see up on the slide, sort of defined as being supplemental or additional interest, fee, or otherwise. And there's no grant of security. So it would seem that it might be possible for a company to use its series by series prepayment right to get an amendment from those who are being prepaid. It's food for thought. Next slide, please, CJ. The last subject I want to cover is EU blocking statutes. Those of you who have been doing deals with European issuers have undoubtedly run into this. Essentially, European issuers are concerned that because of an EU blocking regulation adopted 20-odd years ago, that by agreeing to some of the provisions in our NPA, they will be in violation of EU law. You can see there's first provision up there deals with our representation, and the second one deals with the sanctions prepayment provision. We had one deal recently where the rep didn't seem to cause a problem, but the sanctions prepayment provision and the covenant that is in the model form did cause a problem. It turned out that the sanctions prepayment provision was something the issuer could live with. That, as you know, is if a note holder gets into sanctions trouble because of something the issuer did, then the note holder can put its notes back to the issuer at par. The covenant has two parts. It says the issuer agrees not to be a blocked person, but it also agrees not to have any dealings, investments, and so on with any person if that action would be in violation of US sanctions and could be expected to cause a material adverse effect. So the issuer in the deal that I referred to is of the view that just putting in that covenant without actually doing anything, without actually having a dealing with any person that would violate US actions, but just the agreement itself would cause a violation. So it was unwilling to accept the sanctions prepayment provision. This went back and forth for a little while. And as we discussed it, I mean, if you think about it, the model form does not address many things that could cause MAEs for issuers. We don't address COVID. We don't address climate change. And if you're a home builder and you're putting a development on the coast, that could be a problem, and so on. So the issue is, if you're faced with a situation where a European issuer says, I can't agree to that because I will literally be in criminal violation of EU law. So I just can't do the deal if it's going to be in there. Whether you consider alternative ways of protecting yourself. Now, that the kind of usual way would be to say, well, if I've got covenants, sooner or later, if it really is material, it's going to show up in the covenants. Now, sooner or later obviously means it's a lagging indicator, but nevertheless, the point is you may have to think of alternatives to protect yourself if you run into this we can't be in criminal violation of EU law argument. Now, I wouldn't say just walk away from the covenant and do nothing. It may be time for us to consider, whether the other very relevant provision, the sanctions prepayment right, should in fact be at par. Because if we're going to be forced to take the risk that a company could put itself into difficulty by violating US sanctions, perhaps we should get paid a little more, like a modified make-whole, if the company's action gets us in trouble. So again, that's just food for thought. And again, it's too bad Mark Williams isn't here, because he'd be gnashing his teeth, I'm sure. I think the way a lot of investors get past this issue, in part, is that they look at the issuer and they come to a determination that it's just unlikely that issuer is going to be violating US sanctions. And so, we can live with it. If you've got an issuer, that has maybe 1% of its revenues attributable to sanctioned countries and the proceeds of your notes are not going anywhere near those activities, that's something you could, you may be able to say, okay, I can live with it. A polling question for all of you. The last polling question of the conference. I'm curious whether anyone has turned down a deal because it did not have the full suite of sanctions provisions that the model form calls for. How are we doing, CJ? Okay, that's actually more than I would have thought. That's 1 out of 5. Okay, fair enough. Okay, that's all I have. Are there any questions? I don't think there are. No questions? Patty, you don't see any questions, do you? I don't. Okay. Thanks very much, everybody. That concludes our presentation. Thanks very much for attending and listening in.
Thank you all.
Thank you so much. Thank you, everyone.
Bye-bye.